Welcome back, everybody. Today we're talking about a new addition to my portfolio, and that new addition is Meta. Now, after I sold my Starbucks position, I had a few companies that I was looking at on my watch list, but after watching Meta drop about 15% after what I thought was a very good earnings report, I decided it was time to finally add it. So in this video, we're going to review Meta's business and how they make money, what they've done since the lows of 2022 to turn the stock around, and why I decided to buy Meta after its 5x turned around over the past 18 months. So let's go ahead and get started. Now, Meta's business in general is probably not too much of a mystery. They own some of the most used social platforms in the entire world, including Facebook, Instagram, WhatsApp, Messenger, and now Threads. And these make up their largest business segment called Family of Apps. And those family of apps have a combined 3.24 billion daily active people. And do you realize how insane that number is? Because there's a total of about 8.1 billion people in the entire world. And in terms of those that are actually connected to the internet, there's about 5.4 billion people, which means that 60% of every internet connected person in the world is active on one of Meta's platforms every single day. I mean, that is just an unbelievable stat that shows the reach and impact of what they have going on. But in addition to their family of apps, they have their other business segment called Reality Labs. Now, Reality Labs is where things like the Quest AR/VR headsets live, as well as their Meta smart glasses, and of course, their investments in the much maligned metaverse. And if you look at their revenues over the past decade, you can see that it's pretty much been explosive growth for the past 10 years, with the one exception of 2022, which we're going to talk about here in a minute. But when you look at it based on segment and type, what you see is that as of Meta's last annual report, Family of Apps makes up 99% of Meta's revenue. And of that revenue, 99% of it comes from advertising. So Meta is pretty much exclusively an ad shop, which on one hand can be a positive because they have some of the most unique consumer data available that's near impossible for anyone else to recreate at scale. And on the other hand, it kind of puts them at risk because it's basically all they have, at least for now. But in addition to Family of Apps dominating their revenue breakdown, it's basically all of the profits as well. Because out of the $46 billion in operating income that Meta made last year, Family of Apps made $62 billion of it. And that's because Reality Labs was running at a loss of $16 billion in 2023, which was actually up from $13 billion in 2022 and up from $10 billion in 2021. So at a high level, we can understand that Meta's business is basically about building highly engaging and useful social platforms to be able to then collect and leverage the unique data elements and social graph of their users that are using those platforms. And then they use that data to be able to build one of the best converting ad platforms to ever exist. While at the same time, they've made big bets on augmented reality, virtual reality, and then AI, which they're consistently investing in, currently at a loss, but with the idea that it's going to bear fruit in the future. That's Meta's business in a nutshell. And how I view things like their VR headset and their smart glasses, at least for right now, is an investment to help protect and expand their existing moat. Because if everyone is using their smart glasses and interacting with their AI, then that's even more data that they'll be getting from folks, helping to boost their ad platform even more. And if it ends up turning into something bigger than that, like an additional platform like Apple's App Store, which then could create a new and different revenue stream for the company, then even better. But it's too early to know if that's even a possibility. But I think the two things they have going for them in that space is, one, the Quest headset is a lot more affordable than the Apple Vision Pro, which at least for now means that there can be more interest in it. But then two, the Meta Ray-Ban smart glasses are probably the most practical wearable tech accessory that I've seen since the smartwatch. They're stylish, they look normal enough, and they have enough features that it makes it interesting to actually use. But these are ultimately things that we'll just have to monitor and see how they progress because they're not really a meaningful part of their actual business, at least today. Okay, but let's talk about some risks for Meta. Now, for the first one, their platforms could lose momentum in terms of growth, engagement, or attractiveness to advertisers. And basically, this is because Meta's whole business is dependent on having very targetable data for advertisers to use, as well as the most engaged eyeballs for advertisers to actually show their ads to. So if for whatever reason those platforms stop growing or start losing market share to competitors, then it hurts Meta's ad business. And because advertising is 99% of their revenue, any decline in that business means a decline in their whole business. Now, in general, there aren't many competitors who can really compete with them since they have so many platforms with over 1 billion users by themselves. But I would say YouTube and TikTok are the two most likely ones to worry about from a pure social media standpoint. But there also could be competition from streaming platforms like Netflix and Prime Video as they start to integrate more ads and become an alternative for advertisers who may actually prefer to place ads against known content, as opposed to the unpredictability of social media content, which may be especially true this year as it gets more polarizing the closer we get to the US election. All right, now for the next risk, ad targeting restrictions, either from platform changes or regulatory impacts. Any changes to Meta's ability to collect, track, and leverage user data could substantially hurt their business, since it would reduce the effectiveness and attractiveness of their ad platform. And we saw this happen in 2022 with Apple retiring the IDFA, which literally was an ID for advertisers, due mainly to data privacy concerns. And eventually, Meta found ways to recover from that, but these type of changes will be an ever-evolving challenge, because not only will data privacy continue to be a hot-button topic, but Apple and Google both benefit from making things harder on Meta as well. So while it's impossible to predict when or what may happen in this area, it's something that just needs to be considered as a long-term risk. And then lastly, Meta's AI/metaverse investments could continue to hurt profitability and never really bear fruit. Ultimately, Meta is planning to spend billions of dollars each year, both on R&D, Reality Labs, and CapEx for AI infrastructure. And while this is a practice that they've always done to continue innovating, they've ramped up the spend over the past few years. And when you combine the $35 to $40 billion in planned CapEx spend to the $15 to $20 billion in net losses from Reality Labs, then all of a sudden, this spend starts to add up. And the longer it goes with little to no progress or return on investment, the more impact it can have on their financials and making investors a little bit nervous. While every business is going to have risks, I don't see any major concerns about the three that I outlined for Meta. Other than regulatory items being very hard to predict, I actually think they're well positioned to manage the risks in their business and continue executing at a high level. Okay, so then what happened that made Meta drop 15% after their most recent earnings? I mean, they beat on revenue and earnings both. Their family daily active people was actually up 7%. Their ad impressions were up 20% year over year. The average price paid per ad was up 6% year over year. They bought back close to $15 billion in shares, as well as initiated their first dividend for a total of $1.27 billion. Their headcount was actually down 10% from a year earlier, and they more than doubled their earnings per share from the year before. And if we just take a quick look at their projected revenue growth going forward, it's at about 15%, which is less than their 5-year average and less than what they had last year, but still mid-double-digit growth is pretty good. So on the surface, at least to me, it was really hard to understand what the problem might be because it looks like a pretty good quarter. But I think the 15% drop had to mainly do with two things. One, Meta had been on an insane run for a while, and I think this was partially just people taking some profits after a long run-up, because since November of 2022, Meta returned over 400%, going from about $90 a share to about $500 a share, with only a short cool-off period at the end of 2023. So, numbers or not, this could just be people taking some profits on a great trade. But two, Meta announced that they're also increasing their CapEx spend guidance for the year to continue investing in AI, as well as expecting that CapEx to continue to increase next year as well. And this reminded some folks a little bit of the 2022 Meta, where costs and spending went crazy investing into the metaverse with no real idea of when it would lead to higher profits. So let's talk about what happened in 2022 a little bit and how they were actually able to turn it around. Because 2022 was a perfect storm of issues for Meta that caused the stock to go from $380 a share to $90 a share, losing 75% of its value in the span of just 14 months. And that's because the crazy valuations of 2021 came crashing down as liquidity left the market for safer assets. And the amount of advertising spend decreased as companies were trying to find ways to cut costs. Plus, TikTok started its rise as one of the most popular apps, taking market share and ad dollars away from Meta. Not to mention that Apple released their privacy changes that restricted Meta's ability to track users for ad targeting, reducing the effectiveness of their overall ad platform. And then, of course, Meta was spending billions of dollars on the metaverse at exactly the wrong time without any real clarity on how it was going to improve profitability over the long term. And I even tweeted my thoughts about them back then, saying basically that I thought they were an undervalued cash cow, but just making terrible decisions at the time, which eventually they corrected, and it helped lead to this amazing run that they've been on. And I talked about it a bit in my recent Apple video comparing the two companies. Now let me give you the Meta example. From the lows of 2022 to 2023, here's what Meta did as a business. They cut SG&A costs by $3 billion, or about 13%. They increased revenue by 16% as their ads business grew, and they increased income from operations by 62%. And as of today, from a valuation perspective, they sit at a 33.5 price to earnings and a 25 price to projected earnings. And from an operational cash flow perspective, they're at a 17.86 and a 16.04 projected operating cash flow. So when investors sees that and they say, okay, here's a business that's at a 25 forward PE, they just increased revenue by 16% year over year. They have a documented AI strategy that they're executing on and spending on, and so the opportunity is clear. So just focusing on some basic fundamentals really allowed them to turn it around. And I think the key for Meta is that they're just making so much cash. And this is a really great lesson for us just in our general lives. Like when you have a good income coming in and you have a large buffer between what your expenses are and how much money you're making, then it really gives you a lot of options and flexibility to where you can experiment a little more, you can make mistakes and they're not that impactful because every decision you make doesn't have to be perfect because you're making good money. And this to me is a key point about Meta as a company. I don't necessarily agree with every decision they make, and I don't always even love their platforms. And I'm not even sure exactly what the ROI is for their heavy continued investment in AI infrastructure. But I do know this: they're a cash flow machine. They're generating so much cash with an advertising platform that's almost impossible to recreate. So as an investor, I'm okay if they experiment a bit because maybe it ends up being worth it and maybe it doesn't. But their core business is crushing it right now, and they've shown that when they need to get lean and be more efficient, they can. Plus, from a price to value perspective, they look pretty attractive to me after dropping 15% in a single day. Which brings me to the next question of, okay, we get it, Meta is a good company, but why buy Meta now? And this is the question I've been getting from a lot of people about all of my big tech buys in 2024. Like, why are you buying Amazon in 2024? Or Google or Nvidia or now Meta? Why didn't you buy them last year? Or even this comment, you already do closet indexing by buying the biggest tech companies in the index, so stop lying to yourself and just buy the S&P 500. And now look, I understand, like it's hard sometimes to think things through when we're just busy being mad on the internet, but bear with me on my thought process. Because if you believe that the biggest tech companies were some of the best companies in the market, then you would obviously want exposure to them. That's why we buy stocks. So I could definitely just index and buy the S&P, but if we take a look at VOO and the top 10 holdings, what you see is that Apple's at just under 6% of the index, Nvidia a little bit over 5%, Amazon just under 4%, Alphabet a little over 4%, and then Meta at about 2.25%. And then if we compare that to my own portfolio, Apple's at 10.5%, Nvidia's at over 13%, Amazon's over 12%, Google is about 6.5%, and Meta is just over 3%. And my idea here is that these are the best companies in the market, so I think that they're going to continue to outperform the broader market as a whole. And if and when they do that, the fact that I have a higher allocation to it in my portfolio than the index does means that my portfolio should outperform. I mean, it's a pretty simple strategy. And then my smaller positions like Lululemon, MSCI, Valero, and Caterpillar are ones where, again, I think they're going to outperform the broader market and can raise up my overall performance even more. Because my goal isn't to find the most obscure stocks and hit a home run every time. It's simply to find good companies that I think are going to outperform the broader market and have a higher allocation to them in my portfolio than the index does. But that's really it. And so Meta, with its rock-solid fundamentals, steady growth outlook, and attractive valuation, happen to fit really nicely there, and likely one that I'm going to be adding to going forward. Okay, so how would I rate Meta based on my three criteria of business, operational performance, and valuation? Well, from a business perspective, Meta's social platforms collectively are the most used in the entire world. Their advertising data has an extremely unique and wide moat, but they are almost exclusively dependent on advertising for revenue and growth. Still, I would rate their business as good. Now, from an operational performance perspective, they have excellent margins and profitability, which are actually still improving. Their cash flow is growing at a high rate, and they just started paying dividends while still buying back a large amount of shares. Plus, Meta has zero net debt, so their balance sheet looks really healthy. So from an operational performance perspective, I would definitely rate them as good. Now, from a valuation perspective, they've come up a little bit since I bought, but at the time they were at a price to cash flow at less than 15. And remember, this was a company with projected revenue growth of 15%, a profit margin of greater than 80%, a free cash flow margin at greater than 20%, zero net debt, and they just reported earnings with revenues up 27% year over year, income up 91% year over year, and earnings per share up 114% year over year. So at some point, it's like, what are we even talking about? Like, it just makes too much sense. But still, from an earnings perspective, you are paying over 25 PE. And price to cash flow, even though it looks attractive to me at 15, is still higher than it's been over the last couple of years or so as they were struggling. So from a valuation standpoint, I think it's fair to rate them as okay. So in terms of Meta overall, again, it's not about trying to find the next 5x move. It's simply saying, here's a company that's executing at a high level, looks attractive from a future outlook perspective compared to their current valuation, and it just made too much sense for me not to add it to my portfolio when the market decided to drop it 15% in what I think was a pretty irrational move. So what do you guys think about Meta? Do you have a different opinion than I do? Let me know down in the comments below. Now, if you want to know what I thought the big takeaway was from Amazon's recent letter to shareholders and why I'm so excited about their business outlook, click on this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you on the next one. Peace.